Hello, everyone. I hope that we're doing well. Today, we're continuing on our topic on financial performance evaluation. In the previous video, we had looked at liquidity ratios. We had looked at, how quickly businesses can turn their assets to money, to be able to repay debts that are obligations that are due now. So if there was to be an urgent repayment, how quickly can the business convert its current assets to be able to settle those debts? Today, we're looking at profitability ratios. So we want to look at the amount of profit, that the business is making in relation to some other variables. We'll be looking at the gross profit margin, net profit margin, gross profit markup, and return on capital employed. Okay, when we discuss profitability ratios, actually, what we're looking at is we want to compare how much profit a business has achieved in relation to, like I mentioned, different variables. It could be revenue, it could be amounts that has been invested into the business. And you want to look at that either in comparison to other businesses within the industry or in comparison to previous years, so that you see as a business, how are you faring? In this video, we're going to be looking at this four profitability ratios. Let's begin with the gross profit margin. What the gross profit margin does is that it compares your gross profits and it compares that with your turnover, your sales revenue. What the gross profit you have, you compare it to the amount of sales that you have made. And your gross profit, as we know, is your sales less your cost of sales. So now you've taken away you're comparing what you have, after you have taken away your cost of sales, which is your gross profit. You want to compare it to your revenue, your turnover, your sales value. The higher this is, the better, because of course every business would, every investor, for example, who is looking at the profitability of a business wants to have higher profits. So, the higher this figure, the better it is. And then what you use to calculate the gross profit margin is your gross profit over sales revenue multiplied by 100. So you're going to be using your gross profits, you divide that by your sales revenue and you multiply it by 100. Whatever you get, so say for example, you get 56%, what it just means is that for every £1 of sales that has been made, the firm has made over 50% of profit, gross profit. So you've made 56p of gross profit. Let's see how that is. So we have an example here where we've been given, our sales figure to be 120,000 and our gross profit figure is 40,000. So our gross profit margin on the basis of our formula would be what? Our gross profits in this case will be 40,000. So it will be 40,000. You divide that by 120,000 and you multiply by 100. So if you do your calculations, if you either use your calculator so we have here 120. So if you do this, you would have 33.3%. 33.3%. You do the same for the second one as well. You have your 70,000. You divide by your sales, which is 230,000, and you multiply by 100. You use your calculator to do that, so you divide straight away. You're going to have 30.4. And what this means is that for every £1 sales of this 120,000 sales figure that we have, the business is making 33p of every one. Let's try another example here. Here we have our sales revenue. So here our sales revenue is 7,000 for 2016. It is 8,000 for 2017, and it is 9,000 for 2018. Our gross profits across the years has also been given. Gross profit 2016 is 1.4. So do you want to, pause the video and give this a try? So what you're doing now is, don't forget that your gross profit margin is your gross profits divided by your sales revenue and multiply that by 100. So in this case, you would have your gross profits divided by sales revenue and multiply this by 100. So do you want to give that a try? Try it for the 3 years. You can pause the video and do that now. Your gross profit margin, if you have tried that for the first one, should be 20%. And then for 2017, it should be 12.5%. In 2018, it is 44%. What you see is that, in 2016, for every £1 of sales that was made, 20p was made as, gross profit. This went down in 2017. However, this has gone very high in 2018, and this tells us how much profit, the business has done over a comparison of 3 years period. So how much gross profit in comparison to sales. Okay, great. So now let's get to the second one, which is our net profit margin. Your net profit margin is a bit similar to your gross profit margin, right? The only difference is that in your gross profit margin, you're looking at, you're comparing the gross profit to sales. Here, we're comparing our net profit to sales. Net profit meaning that, gross profit was just our sales less our cost of sales. With our net profit, now that gross profit, you have taken away all of the expense elements, from the gross profit, and you have then gotten to your net profit. So that net profit, you're comparing it to your sales revenue. Okay, so and it's still the same thing. The higher this figure is, the better it is for us. The higher the figure is, the better. And it means if for example, we finish solving a question and we have 32%, what that means is that for every £1 of sale that we have, the firm actually is making 32p of net profits. So kind of very similar to the gross profit, but the figures we're comparing. So for net profit, we have net profit margin. We have our net profit over sales multiplied by 100. Let's look at how that comes in. So we'll try the first one. We've been given our sales value to be 250,000, our net profit to be 10,000. Net profit margin is your net profit divided by sales multiplied by 100. So in this case, we'd have 10,000. We divide that by 250,000. And you multiply by 100, and what you should have is 4%. 4%. So if you divide that by your calculator, using your calculator, you would have 4%. Okay, so do you want to pause the video and give the last two a try? Pause the video and give the last two a try. So if you try that, so second one will be 1,004. So this over this, and you multiply by 100, and you should have 4% as well. And the other one also is 15 divided by 120,000, multiply that by 100, you have 12.5%. So you see that for every £1 that is being sold, by this business, you're making 4p for every £1 that's been made. Here you're making 12.5, so 13p for every £1 that is being sold. Okay, and the next one, so far we have looked at the gross profit margin. We have also looked at the net profit margin. Now we're going to look at return on capital employed. Return on capital employed. So in this case, you're comparing your profit figure to the amount that has been invested into the business. Now, this can be looked at, from various perspectives. If I were to be an investor, for example, I want to know what my return on capital employed would be. So, and the reason I want to know that is I'm thinking of, where should I invest my money? If I put my money in this business, how much is the, return on capital employed compared to if I have, I deposited the money in bank, for example, and I was given an interest. So I want to compare the returns on both of them and then use that to make a decision as to where I actually want to make my investments. So, so this ratio actually demonstrates how well the capital in the business has been employed. So for managers, for example, they want to know how much, we've put in so much funds into this business, how much, has come out of those funds. How much has come out of those funds? And like what I was saying, if you're an investor, you want to use it, you want to calculate your return on capital employed so that you can compare them against any form of other investment opportunities that are less risky or that are available for one. Okay, so to calculate our capital employed, we're going to use total amount of capital. So we're here, the total amount of capital that we're using is not just the owner's contribution into the business. Yes, that capital we're going to use that, but we're going to do that in addition to other, to non-current liabilities, so loans from banks, whatever, all of the so we're saying it's capital employed. So everything that has been employed in the business, capital and non-current liabilities is what we'll be using. So whether it's shareholders, shareholders contribution, as well as loans, non-current liabilities. So we're going to be using our profit before tax, interest and tax. We divide that by our capital employed and you multiply it by 100. The difference between your return on capital employed, which is your whole capital, and return on equity is that in your capital employed, you're looking at all of the capital that has been employed in the business. But with your return on equity, you're just looking at the equity amount, and that is net profits, divided by equity, and you multiply that by 100. So you have, with our return on with our ROE, you would usually have your net profits. So you have your net profits. You divide that by your equity. You divide that by your equity. Okay, so I hope this is clear. So wherever you've been told to calculate your return on capital employed, you just use your profit before interest and tax figure, divide that by your capital employed. So your capital plus non-current liabilities, multiply that by 100, and that will give you your return on capital employed. If you're looking for your return on equity, you're going to use your net profit figure, divide by the equity figure. Okay, and then the final one we're looking at today is our gross profit markup. Gross profit markup. So the difference between your gross profit margin, if you remember, we had calculated our gross profit margin. In that calculation, we're comparing our profit figure to our sales figure. But with the gross profit markup, you're comparing your gross profit figure to your cost of sales. So we're comparing it to our cost of sales, figure. Both gross profit margin, gross profit markup are all looking at, we're trying to look at the profitability of the business, but we're just using different variable. We're looking at, you're comparing your profits, to a different element. Whilst the gross profit margin is looking at the sales element, the gross profit markup is comparing your gross profits to your cost of sales. So what we're doing here is that you just pick your gross profits, you divide that by your cost of sales. And the higher, the better, because we want to make profit. We want our profits making to be higher. Okay, so far we've looked at the profitability ratios, and we have looked particularly at gross profit margin, net profit margin, return on capital employed. We've touched a little on return on equity, and then we have just finally looked at gross profit markup. In subsequent videos, we'll be solving questions in relation to this. So please ensure you understand this before you watch the videos where we're answering just questions. I'll see you later.